I've never seen anything like this. This is the term that everyone keeps throwing around is the word backwardation. Backwardation is an environment that shows extreme delivery stress. Uh, it's unprecedented. This isn't just volatility in my mind. It's the market exposing the shortages of physical silver, the frailty of the paper promises. This is something that I think is just beginning, and there's just far more demand for physical silver than there is the availability, and the paper system is beginning to show great strains. People have accepted paper promises for a very long time, and I think that's coming to an end. And look, this is decisively bullish for silver and other precious metals, but I think it's beginning to show that the paper promises that this whole Western system has been based upon is starting to break. In London, they have a 140 million ounce float, yet they're trading 600 million ounces a day in contracts that technically are deliverable. What could possibly go wrong? There's over 2 billion ounces in paper claims out there on a float of 140 million ounces. So that's exactly what it is. It's a situation where the paper promises, this rehypothecation is being called on the mat. And you can see that. Look, for example, the lease rate in silver in London, when you lease silver in London, it would be something like you want to short a contract. You want to short the price of silver, but you don't have the metal. So you have to borrow metal through leasing it in order to deliver the metal, to short, to drive down the price. Normally, that lease rate is somewhere in the neighborhood of 0.5% or 1%. In October, it's jumped up over 39% to over 39%.
Wow.
And at the same time, we've seen silver rise since August, when the lease rate was at about 1% or so, up to $53 here. So you see the price rising, the lease rates rising. We're seeing the exact same thing in platinum, but it's a situation where right now you have the spot market trading well above the futures price. In other words, buyers are very desperate for immediate delivery. And it's very rare to see this, Adam, in silver.
Yeah.
It's very rare. It signals urgent demand, depleted inventories, and really a systemic shortage of deliverable bars. And that's all because of rehypothecation. In other words, it's getting called onto the carpet. I mean, you're seeing delivery stress on that is exacerbating it on COMEX. We've already seen 16.5 million ounces delivered in COMEX, adding to the limited vault supplies. But yes, the main stress is in London right now, and much more so than on COMEX. And really, it is, in my mind, the epicenter of where all of this could really get into some serious problems, where you're beginning to see margin calls for traders out there who are receiving a margin call because the price is going against their short position, and the lease rate and the borrowing costs are so high that they're not able to get the silver to cover their position. And that's when things begin to get very, very, very interesting. What it really tells us is that buyers aren't just rolling over their contracts like they used to. They're standing for delivery. They're demanding real metal. And these delivery numbers are well above normal. So I guess if you could encapsulate it easily, it's that the rush for gold and silver is real. It's intensifying. And markets just aren't trading paper contracts right now. The people want the real metal in hand. And in a world where paper contracts are vastly overstating the supply, that becomes a problem. The short-term implication would be liquidations and survival-driven selling can trigger volatility. That's the short term. Even sharp pullbacks. Medium term, as far as I'm concerned, is that once this forced selling ends, the physical scarcity starts to dominate. And silver sustains its higher prices, $50 plus. But long term, if confidence in this paper system collapses, like we're seeing, a structural reset could start to reprice silver. That's what I'm seeing. $75, $100. And I say that to you, and that's not pie in the sky, because if you take the 45-year cup and handle that goes like this, the way technical analysis works is the top of the cup, 1980, the bottom of the cup, the early 90s, and again back up to 2011 again, which is near the top of the cup, and then formed another It's a double cup and handle. But the way that it works is once silver has broken through 50, which it has, technical analysis would say you take the distance from the bottom of the top, which was $46, from 50 to 4, and you add it to the top. That would mean that the next target from a technical analysis standpoint is $96. And I think that's exactly what you will begin to see, where the market physically begins to exert itself over the paper shenanigans that we've seen for a long, long time. The United States for the last 40, 50 years has bet on a strategy of strong dollar and U.S. bonds and service jobs, where the rest of the world, in particular the BRICS and China, have, you know, have not been ignoring the factories like we have not been ignoring commodities like we have. China, as a good example, did the opposite. It built factories, accumulated commodities and gold, and now is really pushing away from relying upon the dollar. That is ultimately, I think, where we're going. Yes, exactly that, right there. You are beginning to see premiums start to blow out. And even worse than that, what you're going to see is a massive spread between buy and sell, because it's narrowed a bit to about $1.80. But yesterday and the day before, we were about a $3 spread between the futures price and the spot price. So let me explain what that really means. If I'm going to buy 100,000 ounces of silver, and the spot price says $52, but I'm not able to hedge it on the futures contracts at anywhere near that price. It's actually $48 that I can hedge it at. That's what the futures market is. This is backwardation. In other words, where the futures price is lower than the spot price. It's very, very unusual. Normally, it's called contango, where the spot price is X and the futures price is X plus 1, plus 2, plus 3. The further you go out, the more you're supposed to pay for the time value added of money. It's like if I loan you money and you're going to pay me back tomorrow, I probably won't charge you interest. But if I loan you money and you're going to pay me back in 6 months, well, I probably am going to charge you interest, kind of thing. Well, that's exactly what contango would be. That's a normal market. The backwardation is the opposite of that. So for dealers who have to buy metal at X, they can't hedge it anywhere near X. It's X minus 3. So you're exposed. There's a big spread between buy and sell, and the premiums are jumping noticeably on the Eagles. And this is exactly what we saw during the pandemic. The premiums on Eagles, every major dealer in America right now is north of $6, $7, $8 an ounce over spot. Just like that. I've been screaming to everyone for the last year and a half that it's very unusual how low the premiums have gotten. And now the U.S. Mint, which once again is the model of inefficiency, is not able to keep up. Gold buffaloes, right? As an example, gold buffaloes. Our cost on gold buffaloes is north of $200 over spot. Our cost before we make a penny. Right now, the biggest distributor, one of the biggest distributors in America, who I do a lot of business with, their cost on selling me silver eagles, if I buy massive amounts, will be north of $6 over spot. That's before I make a penny. They have no platinum, zero in stock. These are massive wholesalers that trade in the billions of dollars per year. We're beginning to see a system where the paper versus physical divide is breaking. The credibility of paper, silver, and gold and platinum futures, especially unallocated accounts, is eroding as more and more players demand physical settlement. And that's going to exert itself in the premiums that you see in the retail market. It's becoming much harder for dealers like myself to balance that. Not only is there a lack of liquidity, but you have this huge spread between futures and spot, so it's hard to hedge your position. I've asked my traders to go way, way out over the last month or two when supply was abundant and premiums were low. I knew that this wouldn't last. And so we go way out on our line of credit. We buy everything that we can. We are a company that is wholly owned. We are not subservient to financiers and to investors. We don't have to keep this really thin margin and huge profit level for investors. Instead, we reinvest our profits back into the business and go super long on inventory. I would say that during COVID, no one came close to the inventory that we had. And I would go into future months, 3, 6, 9 months out, make purchases with money down, commitments. And I've done the same thing here. I've loaded up on anything that wasn't nailed down. Instead of taking big distributions, I put my money into buying more product because I think that is ultimately going to be a hallmark of this industry. Look, I did an interview with Rick Rule the other day, and once again, he said the exact same thing, Adam. He said, 1/2 of 1% allocation, and it's not just physical metal, it's physical metal and metal equities, he says,
Hmm.
from Joe and Jane Sixpack to the Harvard Endowment Fund. Now, he always used to say that exact same phrase, and I borrowed it from him. Funny thing is, the Harvard Endowment Fund just bought over 100 million in gold. So I don't know, things are definitely changing. But yes, you will witness it. See, during the last year and a half, the price has been low, the demand hasn't been very high, and it's only the people like your listeners who understand the importance of owning it. And so the refiners and the dealers and the wholesalers who have been choking on product, they haven't gone out of their way to replenish. And just like that, things change. And I say that all the time, and it's so hard to say this stuff because you get the cynical people out there say he's talking his book, BS,
Hmm.
but I'm not. I've seen it over and over and over again. And so now what happens, you're going to have a lag time, right? You're going to have a big lag time into December where the futures price is well below the spot price, making it very hard for people to even hedge that long exposure. I have done it because I knew that markets repeat themselves. I knew that we were living in a very tenuous environment. So, yeah, we have a very good supply of product. But again, when you realize that such a small percentage of the public really has any exposure, that can change very quickly. We've been fortunate enough to have the Sprott brokers run all their business through us, where Rick used to be the CEO.
Right.
And one of their brokers, or a few of their brokers, have been placing massive orders over the last several days with us, indicative of smart money, I think, realizing that something is broken and things are changing. So it's not just my brokers, it's not just our business. We work with other people like the brokers at Sprott. And I will tell you that the demand at a level of sophistication that you speak to, the people who you speak to, I would say are far more sophisticated than many of the financial advisors that they would work with mainstream
Hmm.
because they understand the big picture, right? You go to a financial advisor who might be the best in the business, but doesn't acknowledge that the world is the way that all of us think it is, the macro picture, the geopolitical picture, which is so very, very important to understand if that's going to be the backbone of advice that you're given on your portfolio. So I guess all I can simply say to you is that most people are going to be caught off guard by this. And
Hmm.
it will go from an environment of high prices that will identify the market to most people to your people saying, geez, I can't get it easily. It's disappearing. And just like that, it will disappear. So while things are good right now, Goldman Sachs said, if if the market even suspects for a moment that the Fed is losing independence and 5% of the money that's embedded in Treasury shifts to gold, the price will go parabolic. Will go well
Yeah.
north of 5,000. It's going to go well north of 5,000 because Stephen Mirren is the architect of the Mar-a-Lago Accord, and he is now on the Fed. He was Trump's big advisor, or even this Bo Hines, who was Trump's crypto advisor. He's now running USA Tether, which is backing the Genius Act. There is no independence. The market is going to catch on. The big money is catching on. The rest of the money will too. And then getting product will be very difficult because we've gone a year without any of these wholesalers or refiners or big importers finding much need to go deep into their lines of credit to secure product because there wasn't any need to. I knew there would be. And whether I was stupid or lucky, I'll tell you that there are very few companies out there that have the inventory that we do right now.